Exercise 1-12. At the beginning of March, Bristol Software Company had cash of $12,000, accounts receivables of $18,000, accounts payable of $4,000, and G. Bristol Capital of $26,000. During the month of March, the following transactions occurred. So you're asked in the instructions to put all the transactions in a tabular analysis. The first row contains the company's beginning balances. So the beginning balances are here. In this first row, we've set up cash of $12,000, accounts receivable of $18,000, and notes payable of $4,000, and Bristol Capital of $26,000. So what we're doing here is basically setting up our accounting equation. Assets equals liabilities plus owner's equity. And we know that our assets have to equal our liabilities and owner's equity. So after each transaction, this every column added up the assets and then should equal the liabilities and owner's equity. So let's look at the transactions. The first transaction was purchased equipment for $23,000 from Digital Equipment, paid $3,000 cash, and signed a notes payable for the balance. So we have transaction 1. So again, it said we paid $3,000, so that would be a cash outflow. We've paid it, it's leaving our cash balance or our bank account. So I always like to start each transaction with cash because it's easy to understand. Did I pay it out or did I receive it back? Okay, I bought equipment for $23,000, so that's the value of the equipment. So our assets is going to increase by the value of the equipment, $23,000, but we're going to decrease our cash by $3,000 because we paid $3,000. The rest, it says we paid a notes payable. So as you can see on our other side of the equation, we have $20,000. So we now owe the company $20,000. So Digital Equipment, we need to pay back $20,000 plus interest for purchasing the equipment. So basically we paid 3 and we owe 20. So if we look at each side of our equation, equipment 23 minus 3,000 is 20, and then we have 20 on our liability side, so it balances. All right, transaction number 2. Received $12,000 from a customer for contracts billed in February. So when we billed them in February, we would have set up that they owe us or accounts receivable. So again, we know our cash transaction. Cash increased by $12,000, we physically received it, and accounts receivable decreased by $12,000 because we no longer owe that money, or we're no longer owed that money by the client. Transaction number 3. Paid $3,000 of March rent of office space. So as you can see, we've paid, so that tells us it's a cash outflow, so our cash reduces by $3,000, and we paid for office space, which is rent. So as you can see, our expenses decrease our owner's equity. It's an outflow, or if it's an economic benefit leaving the organization, I had to pay. In order to run business, I needed a place to have office space. So it's an expense. So we reduce expenses, reduce our owner's equity. So that would be rent there. And so we minus the expense of $3,000 on the one side, and then we subtract $3,000 cash on the other. Transaction number 4. Paid $2,500 of the amount owing to suppliers at the beginning of March. So again, that word paid, I paid it out, so it's a cash outflow. I subtract $2,500 from cash, and it was money I'd already recorded as I owed, so that's accounts receivable. So I'm going to decrease the amount I owed. I've paid it back. I no longer owe that $2,500. So I have minus $2,500 on both sides of the transaction. Number 5, provided software services to Quan Construction Company for $7,000 cash. So in this case, we provided a service to Quan and they paid us cash. So we didn't invoice them and have set up a receivable. We actually physically received the cash. So that's going up. So that increases our cash and that increases our revenue. We've earned that money. So again, $7,000 on both sides of the transaction, or both sides of the equation. Transaction 6, paid BC Hydro $1,000 for energy used in March. So again, I'm running a business. I have to have electricity or power to run my office. So again, when I pay a bill, it's a decrease in cash if I've paid. So that's minus 1,000, and we have minus 1,000 in our expenses for utilities. Transaction number 7. Brister withdrew $5,000 cash from the business. So we need to recall that we need to keep personal transactions and business transactions separate. So if the owner takes out money for personal use, we need to reduce the cash in the business by $5,000. And we call it drawings or withdrawals that they've withdrawn money from the business. It reduces the capital they have invested into the business. They've removed it from there. So again, minus 5,000 on each side. We then get into 100 on account of the notes payable issued for the equipment purchased in transaction 1. Of this, $100 was interest expense. All right, so we know for most parts when we borrow money, we have to pay interest. So the notes payable of $20,000 that was set up originally was the principal. That's how much I owe back, plus interest. So the total amount I paid, it said, was $2,100. So that's the cash leaving. I actually had to pay cash of $2,100. 100 of that, they said, was interest. So we had to pay interest, right? That's the time value of money. They've lent us that money, so we pay them back for that service, which is $100. And then we reduce how much we owe by $2,000. So now we only owe $18,000 in principal. Transaction 9, hired employee to start working in April. So if we hire someone, we don't actually have to pay them till they actually show up to work and work for us. So in this case, we've agreed that they're going to start work, but they haven't yet. So there's no actual cash transaction or service owing or anything else. So it's no entry for accounting purposes. All right, number 10, the final one, incurred advertising expense on account for March of $1,500. So again, it's going to be, we received an invoice for advertising expense. We haven't yet paid it, so we now owe that money to the advertising firm. So that becomes an increase in liabilities. We owe $1,500, but that's an expense for March of $1,500. So we increase our expense, which is a reduction in equity, which is why it's a minus. So we have a plus and minus on the same side of the equation. We increase our liability and decrease our owner's equity in the expenses, and that was for advertising. So once we finish all of our transactions, we get our totals. So this is our new updated accounting equation, and we make sure it balances. And so as long as it balances, our assets equals our liabilities and owner's equity. So we've now have our updated balances at the end of the month.